On today's episode, we are going to take a look at two stocks that are down today. The first one's going to be a software company. The second one's going to be a semiconductor company. They're both profitable and they're both super positive in cash flow from operations. Like always, for each company, we're going to take a look at future growth, fundamentals, recent earnings, technicals, and even valuation metrics. So let's get started. The first company we're going to take a look at is Autodesk. This is the software company. They provide solutions for architectures, engineer, product design, and manufacturing, and also for media entertainment. Their software, the easiest way to understand is if you're trying to design a product, if you're trying to design an animation or cartoon, you use their software to make that character, to make that product. Autodesk right now is traded under the Nasdaq as ticker ADSK. Today the stock price was down about 2%, and we're going to take a quick look at why I believe the stock price was down. But if we take a look from its 52-week high, the stock is down about 12.8%. Right now it's sitting at $278.89, and it has a market cap of $61.3 billion. If we take a look at future growth, this company is expected to grow on average 14.3%. So I would consider for the next 3 to 5 years. So I do consider this to be a nice growth stock. This is also one that is profitable if we take a look at trailing 12 months, and also positive in cash flow from operations. So fundamentally, things are looking pretty well. Now, if we take a look at their balance sheet, they have about $900 million in cash and short-term investments and about $1.6 billion in debt. They are a bit leveraged, but I would say this is okay for me because we saw that super positive cash flow from operations. We also saw that positive earnings. If we take a look at historical growth, in 2018 they grew 24.95%, in 2019 they grew 27.41%, and in 2020 they grew 15.76%. So not only are they expected to do strong future growth, they have a history of strong growth as well. If we take a look at trailing 12 months gross margins, this company seems to be improving throughout the quarters. Now, if we take a look at profit margins, they are also in an uptrend, which is great to see. There are some stragglers here and there, but the positive trend shows a nice growth in profit margins. Next, what I'm super excited about their fundamentals is their operating cash flow margins. They keep about 37.13% of their revenue as operating cash flow. This means this is a business that keeps a good portion of cash from their everyday business, and it has been improving throughout the quarters. So reasons like this is why I don't mind that they are a bit leveraged right now. But before we take a look at their earnings, guys, make sure to hit the thumbs up and the subscribe button if I am providing some type of value to you. If we take a look at their most recent revenue, they grew 12% compared to the same time last year. If we take a look at their revenue mix, they are seeing growth in all their department sectors. The architecture, engineering, construction saw 16%, manufacturing saw 8%, media and entertainment saw 11%, and their overall AutoCAD and AutoCAD LT saw 9%. They're also seeing growth in all the geographic regions that they're hitting, 20% in APAC, 8% in Americas, and 11% in Europe, Middle East, and Africa. Another thing I do like about Autodesk is they are being very aggressive with acquisitions. On June 6th, which was yesterday, Autodesk confirms a proposal to acquire electronic design software leader Altium Limited. As an electrical engineer, I know Altium Limited pretty well, and I do believe this would have been a smart acquisition for Autodesk. Unfortunately, news came out today that Altium rejected their offer, but Autodesk recently on March 31st also made another acquisition of a water infrastructure modeling and simulation company. So we can see Autodesk is definitely pushing forward to increase its overall markets and is trying to make smart acquisitions. So the second company we're going to take a look at is Broadcom, and this is another money maker. It's impressive the amount of dividends that they have and the overall market that they're in right now. But before we go any further, let's take a quick listen to today's sponsor. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services the Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the stock advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. So Broadcom is the semiconductor. They have plenty of solutions for different markets. If one wants to learn a little bit more about them, I definitely recommend taking a look at their investors presentation website. Here we can see their fiscal year 2020 revenue segment is pretty much broken down into markets. The semiconductor solutions, which they have for networking, for broadband, for server storage, wireless, industrial. They also have the infrastructure software, which deals with mainframe, DevOps, Value Ops, and AI Ops, cybersecurity, and storage area networking. And if you continue to go in their presentation, they go a little bit more within those. For example, in the industrial world, they have, for example, motion controller encoders. They have these optical sensors, which work pretty well in automotive electronics. They also have LED solutions, which can pretty much be used in anything we work on in life right now. And you can go throughout the presentation and pretty see the different types of solutions and markets they hit. So Broadcom right now is traded under the NASDAQ as ticker AVGO. It's currently sitting at $463 and today was down 2.3% as well. Even though the NASDAQ was up for the day, if we take a look from its 52-week high, the stock hasn't really seen much of correction, is down about 5.25%. And we're going to see this company has a strong dividend yield, 3.1%, and it is profitable. If we take a look at fundamentals, this company is expected to grow 5.5% on average for the next 3 to 5 years. So this is more what I would consider a form of value play to some extent. Maybe not in stock price right now, but the overall company itself. It's one that is growing at a modest level, but why? Because it is profitable in earnings and it is super positive in cash flow from operations. This is also a company that's paying a strong dividend of about 3% or so, which is higher than the industry average. If we take a look at their financial health, Broadcom right now has about $9.6 billion in cash and about $41.9 billion in debt. So you're gonna see Jose, this is super leveraged. This is true, but remember, this is a monster when it takes a look at cash flow from operations. Every year, they make about $12.8 billion there. They're super profitable, so it allows them to be a bit leveraged. Obviously, I wish they weren't as leveraged as they are right now. If we take a look at recent revenue growth, in 2020, it grew 5.7%. In 2019, it grew 8.3%. And in 2018, it grew 18.2%, right? So it's not known for being a growth monster, but at least it has history of seeing revenue growth. What I'm super excited about this company is, look, their operating cash flow margins, if we take a look at trailing 12 months, is 50%. That means 50% of their total revenue is being kept as operating cash flow. This is a super money making machine. This is pretty much a company that prints out money. The only time I've ever seen operating cash flow margins this high has been in software companies. So I'm pretty impressed to see a semiconductor company with hardware solutions kind of hit these kind of margins. I honestly can't see why the stock price is down right now. If we take a look at recent events, they reported earnings not too long ago. And since they reported earnings, price targets have been increasing for Broadcom. Nonetheless, this company is still down. In their most recent revenue, they saw 15% year-over-year growth. They also announced a quarterly dividend of $3.60. And if you are a dividend investor, you are gonna like this. This is a company that for the past 6 years has seen 49% compounded annual growth rate on their dividends. So this is definitely a nice dividend to play in the market that's growing. All right, so now that we took a look at both stocks, I want to take a quick look at technicals. The first thing I want to make sure is that they're not overextended. So we can see Autodesk right now is sitting at its medium moving average and it's below its short-term moving average. So I wouldn't say Autodesk is overextended right now. Now, if we take a look at Broadcom, Broadcom is a little bit different. It is not overextended from its short-term moving average, but it is a bit overextended from its medium and long-term moving average. So this doesn't really deter me from buying or selling a stocks. Now, if we take a look at valuation metrics, I'm taking a look at forward price to sales ratio. Let's start off with Autodesk. Autodesk right now is sitting at 11.5. Normally, this is where I like to see software companies around closer to that 10 valuation. And these are values that this company has seen since before July of 2020. That's pretty impressive. If we take a look at Broadcom, though, Broadcom hasn't seen much of a correction and is actually a lot higher than it's normally at. So its valuation seems to be a bit overextended. Now, if we take a look at another metric, EV to EBITDA forward, I see the similar results, right? Right now, Autodesk is sitting at values that it it's seen in around July of 2020, almost a year ago. And Broadcom seems to be a bit overvalued compared to the past. Again, this doesn't really show me that, hey, it's a bad time to or a good time to buy any of these companies. It just shows me if there's a little more risk than expected. Now, my overall thoughts. I do believe both companies have strong fundamentals. My favorite would actually be Autodesk. Autodesk, if it was to ever enter my portfolio, and it has in the past, it's not in my portfolio right now, it would be somewhere around a tier 2. Broadcom, because of Broadcom doesn't really match my portfolio style, right? I'm not too heavy into the dividend plays, but let's say I ever wanted to kind of slow down with growth and focus a little bit more on value plays and a little bit more on the dividend plays to just kind of have a more stable portfolio, I think Broadcom would be one, and it would be in similar, a tier 2 stock. So I hope you guys enjoy. Make sure to hit the thumbs up, subscribe, and see you next time.